For the settlement, the collateral for the settlement, I think it's for it to ease settlement. There are instances where there's a gridlock, and then some banks are not really funded for their settlement. So that collateral helps the settlement process a lot easier and more efficient.
Right.
So we did see some mixed sentiments in the market last week. We saw yields go down 5 basis points on average in the T-bill space, and then it advanced 18 basis points in the benchmark bonds. What would you say were the key drivers of this mixed sentiments that we saw?
It was as a result of the liquidity in the market last week. Coming in from last week, we saw FAC into the market. Then we saw about 220 billion stabilization securities mature into the system with all other maturities. So coming in from the maturities in the system, we had about 400 billion, coupled with the fact that we still had FAC in the market. So that's for the buying spree in the fixed income market, moderating yields across.
So clearly there's been a lot of liquidity in the market, and that has been the case for a while. And in the past, there has always been that argument that too much liquidity is going to put pressure on the currency, the exchange rate. So have we seen that pressure? What can you tell us about the dynamics there?
We've seen pressure in the FX market, and then we have seen the central bank step in to, help to ease the pressure. The central bank has commenced selling wholesale, where you get a part of your winning spot and then the rest forwards. And then we've seen continual retail auction in the market. For the I&E window, we saw rates increase up to about 362, 363 in the market, but we hope that will moderate as we see more interest from the investors in the market.
And still hammering on liquidity and CBN's efforts with settlement banks. Just ahead of the latest instruction that the CBN gave this morning, we saw one last week on the back of influencing liquidity, ease of doing business with investors, China's exchange, FX exchange deals with Nigeria. What influence do you think that also would have on liquidity, seeing that that's what the CBN has been hammering on?
For liquidity, we'll see a lot of economic... we have a lot of liquidity in the market right now, so we've seen banks commence a lot of lending to customers. That is going to help the financial situation of the market. But for FX, I think there's going to be a little pressure because Nigeria is an import-dependent country. We have the reserve to support that, and we hope that it won't be so bad as time goes on.
Can you just help us appreciate what's going on with foreign investors? Say over the last 2 weeks, are the flows declining at all? Because so much has been made of the risk around the elections and how that will influence how investors will be invested in Nigeria.
On the average for the past 2 weeks, we've seen little or no difference on it, and we hope that doesn't change, and I'm sure that the central bank has an eye on what is happening in the markets I'm sure they have things in place to be able to boost their confidence. So on the average of 2 weeks, little or no difference for now.
We did also see in the course of trading last week that the FG's T-bills were oversubscribed by about 4 times. What were the key drivers of that?
Liquidity. There's a lot of liquidity in the market, and they're not taking it as fast as they used to. Nigeria, the last calendar that came out for the fixed income, the offerings were halved. So we don't have a lot of assets taking it out. And then in the OMO operations, they're not coming as fast as they used to, once a week, twice a week, and they're not taking all out as fast as they used to. So there's a lot of liquidity, and that's putting a lot of pressure on the FX.
I want to come back to the issue around the impact of liquidity on the exchange rate.
No, I see where your earlier fears came from on excess liquidity, what that could mean for us.
No, it's certainly a big issue. Many people have mentioned this over time. But it's clear as well that the central bank is allowing that liquidity to throng the market a little bit, and as a result, we're seeing rates ease a little bit. The big question is whether or not this can be the new normal and we'll still see the currency relatively stable. Given the resources of the central bank right now with where foreign exchange reserves are, do you think that is still a big risk?
I'll come from the side of the central bank. I think they want to spur lending to the commercial market, to the market, to our customers, And is that the new norm? If it works, it's going to be the new norm. We'll wait to find out. We have an MPC in 2 weeks, and we'll see what they do with the benchmark indices, and then we'll take it from there.
So we see the federal government now continue to shun debt following its quest to reduce the costs of debt service. For how long do you think it can actually hold out?
I'm not in the right... I can't speak to that, but I think it's a right step in the right direction. for them to try and reduce debt and stimulate the economy. And then, like I said, there's an MPC in 2 weeks. We'll look
Let's look forward to that MPC. Do you think we're going to get any surprises this time?
Oh, most definitely. I think.
So, what in terms of a rate cut? Or?
Yes, I think there's going to be moderation in the benchmark rates because of what we've seen in the auctions.
But so we're taking that the dynamics in the auction market, the OMO auction market, as a signal that the central bank is more willing to allow rates to ease. But many have also argued that they don't necessarily have to tinker with the benchmark rate. They can continue to do this and still keep the benchmark rate where it is. Why do you think it's important for the benchmark rate to come down as well, to more or less solidify the sentiment that, yes, we're in a lower exchange rate environment?
Okay, from my perspective, the benchmark rate speaks to a lot of fixings. Some assets are priced at the benchmark. When people want to invest in Nigeria, they look at the benchmark. What is the benchmark? So it is tied to a lot of fixings, a lot of agreements. And if the rates in the markets are moderating very fast and the benchmark, I think there's some sort of imbalance. So I think, from my perspective, that's what I think.